Hi, welcome to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'm going to be reporting flows for the week ended September 5th, 2012. Investors injected about $1.6 billion of net new money into the conventional fund business, that is exclusive of exchange-traded funds, but it really was on lackluster ideas. I mean, if we take a look at this, we had a wait-and-see attitude, and that was basically due to this shortened Labor Day week that we've been actually participating in this week, and also investors anticipating news out of the European Central Bank, out of the FOMC, and also we're supposed to be receiving reports of non-farm payrolls. We actually received it this morning. But when we take a look at it, the only discouraging news that we actually saw during the week was the ISM manufacturing index came in below 50 for the third consecutive month in a row, and certainly that put some jitters into some people's steps. So people were sitting back basically because news was coming out. They had a shortened week. They came off Labor Day weekend, you know, three-day holiday, and they basically were going to sit on their hands and wait. But let's show you how this shook out in the industry by giving you our macro group breakout. Equity funds lost about $900 million from their coffers. Taxable bond funds took in $1.5 billion. Pretty good amount. Muni bond funds actually saw about $200 million of net new money, and surprisingly, we only saw about $700 million of new money come into money market funds. Again, it was this lackluster four-day trading week that we can probably hang our hats on, you know, for kind of the low volume, the low attitude, and low investments coming in. But let's take a focus look now at what happened to our equity funds. Equity funds basically saw, for the second week in a row, about a 0.32% drop in their performance. Well, we had 6 consecutive weeks of upside performance. The last 2 weeks certainly were a little bit discouraging, but certainly we had good news. On the 30th of August, 31st of August, actually, we were reported that NASDAQ and Dow both had positive returns, but it wasn't enough to get investors to put more money back to work. So they took money out. What we saw is that of this $900 million of money leaving their coffers, domestic equity funds actually lost the lion's share of it. About $1 billion of monies exited their coffers, while we saw about $98 million, very small amount, come in to non-domestic equity funds. Well, certainly the story has been that way for a while. We've been talking about domestic equity funds actually suffered their 7th consecutive week of outflows. But interesting, people are still playing to the dividend yield type of play. So we saw money coming in to equity income funds, about $182 million of net new money coming into their coffers. Not a lot, but again, remember, domestic equity funds saw outflows. But interesting enough, what we saw is the international equity funds took in about $129 million of net new money as well. So people, even though we have, you know, some European issues going on, people are still padding the coffers, finding some deals out in the international equity market for mutual funds. Well, let's take a look at the equity ETFs now. And that was a tale of two cities. Basically, we saw outflows out of this group. $7 billion of money left the coffers, but really one fund was responsible for just about all of it. SPY saw about $6 billion of money leave their coffers. And we also saw some other outflows as well, kind of minor areas of outflows, you know, $500,000 here, $500,000 there, but certainly the big story was seeing money flow out of SPY. In addition, at the top of this chart, we actually see net new money coming in. We saw IJH, the iShares S&P Mid-Cap 400, taking about $300 million of net new money. But again, I think the big story here was investors, probably on the institutional side, deciding they did not want to stick and hold on to SPY while we're going through the ECB making up their minds, FOMC making up their mind, and certainly we had not heard of the non-farm payroll reports, and certainly something that we've all been keeping an eye on. Well, let's take a look at some of the areas that have been putting money back to work, and that is our fixed income universe. For the 13th consecutive week, we actually saw inflows into this group. $1.5 billion net new money entered this group, and this is the third consecutive week we actually see positive returns, about a 0.24% return. Again, nothing to write home about, but certainly positive is always appreciated. But one of the issues that we saw was a change of pace. We've been seeing a lot of money going into the high yield emerging market debt type of funds, and high yields especially. But this week we saw that corporate investment grade debt funds basically took in the lion's share of what came into this group, $738 million, and we saw flexible portfolios take in about $262 million into their portfolios. So really there was a risk off attitude here. Again, corporate investment grade debts are a little bit more risky than, let's say, Treasuries, but certainly not not as risky as emerging market debt or as high yield funds as well. So we saw that. In a tale of two cities again with ETFs, we saw just the opposite. Basically, if we take a look at this group, we saw that risk was on. A little bit of money coming into the riskier assets, but certainly if we look at down at the bottom of this chart, we see Treasuries actually taking it on the chin. IEI, which is basically the Barclay 3 to 7 Treasury, lost $830 million of money, and ProShares Ultra Trust 7 to 10 year lost about $300 million. So certainly in the ETF arena, people were taking more of a risky chance and putting money, back to work in the riskier assets, but then taking money off of what people would call the safe havens of treasuries. Well, let's take a look at the muni bond funds. This has been a story for quite some time. For the 21st consecutive week, we saw net new money coming into this group. Might have been only $200 million of net new money, but certainly has been a story for a while. There's a third consecutive week they were able to post positive returns, and it's just the story that we've been talking about. Certainly there's two issues coming up. We've heard a lot about possible changes in tax law. There's not going to be a lot of being done in Congress, and in addition, people are concerned about upcoming presidential election. But in addition to those, we really saw, and we've been reporting on it, that there has been tax equivalent yields that benefit the muni bond investor over the taxable bond funds. So certainly for people in taxable accounts, they're going to make that particular difference. Well, when we take a look at money market funds, that's probably where we saw one of the biggest changes. We've been seeing a lot of rock and roll, a lot of ins, a lot of outs, real wild movements in money market funds. And this one we only saw about $700 million actually enter the coffers of these groups. It's the fourth week in 5 that we've seen inflows, but how we break them out, taxable money market funds saw about $800 million in outflow, while tax-exempt money market funds saw about $1.5 billion in net new money. This is the first week in 4, by the way, that the tax-exempt money market funds saw some inflows. And we do a breakout a little bit on the money market side, taxable money market side. We actually see that institutional investors put a little bit of money back to work, about $100 million back to work, while we had the retail investor actually pull out about $900 million as well. So certainly kind of a lackluster week overall for all the groups. And as we go forward and we take a look at the European Central Bank and what it's done, we heard that it basically is going to support the euro, and in addition it's going to have a bond buyback. People were thrilled to hear about that as well. It sounds like they're going to take a very aggressive stance here, so that was well received. We saw also that the non-farm payrolls came in a little lower than expected at 96 million, when I think we all expected about 130 million. So a little bit disappointing, but again, numbers were good. We had an unemployment rate of 8.3. It dropped down to 8.1. So things are looking a little bit better on that market, but really investors are still sitting on their hands, and they're going to do so until they hear from the FOMC next week. Well, if you want to do a deeper dive and find out what happened to your groups as far as fund flows goes, go to our website at USFundflows.com, or you can return next week, and one of our analysts will tell you about the trends that are occurring a week from now as well. Well, thank you for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.